The webinar will begin in 2 minutes. The webinar will begin in 1 minute. Welcome, everyone. Thanks for joining us for today's webinar entitled Captive Insurance Companies Take Another Hit. The webinar will last approximately 15 minutes, and at the end, you will be given an opportunity to receive supporting materials by email, free of charge to you. You will also be told how you may email questions related to today's content to the presenter. Today's presenter is Linus Sugis. Linus worked for a Chicago-based insurance company in various roles, including Director of Advanced Sales and as Chief Marketing Officer. He ran and sold a successful estate planning practice in Franklin, Tennessee. Linus also writes the publication Think About It, founded by life insurance industry guru Steve Lineberg, and Linus regularly speaks at industry events. His most recent book, Sell Out, The Busy Entrepreneur's Guide to Transferring a Closely Held Business, written together with a CPA and a business broker, is now available for sale. Linus will draw on his legal, tax, and life insurance background and his practical experience for today's webinar. And here he is.
Thank you, Jennifer, and good morning or good afternoon to everybody on the call, wherever you are. Ever since I got into the life insurance business more than 30 years ago now, hard for me to believe, there's been a search on the part of sophisticated producers for tax-deductible life insurance premiums. I've seen failed attempts to achieve this result with various examples over the year, ideas like charitable reverse split dollar, Section 419 plans, Section 79 plans, for instance, either failed or partly failed. And it seems more and more like captive insurance company plans are falling into that category. And we'll get into that at least briefly today. But before we do, before we discuss a couple of the more recent developments with regard to life insurance and captives, let's go ahead and decide on next month's topic. So we have three choices. The poll will open in just a second. The three choices are, first of all, ethical issues with incapacitated clients. Secondly, dealing with clients with terminal illness. And then the third topic, Roth conversion, yes or no, sorting out whether or not it's a good idea for a client to do a Roth conversion. Let's go ahead and open the poll and go ahead and take a few seconds and cast your vote, and we'll decide on next month's webinar. Go ahead and vote. If you haven't yet voted, please go ahead and cast your vote. Give you another second or two. All right, let's go ahead and close the poll. And next month we will discuss Roth conversions, yes or no. Thank you for doing that. Thank you for participating in that. So let's go ahead and talk about captive insurance companies today. First of all, for those who may be newer or newish to the concept, what is it that makes captive insurance companies attractive? So the income tax laws, the federal income tax laws generally allow a profitable operating business to create its own captive insurance company to protect against certain kinds of risks. In general, these kinds of risks are the risks for which commercial insurance may not be available. So the captive is put in place so that the company can essentially self-insure against the risk. The operating company pays premiums to its own captive insurance company and gets a tax deduction for the premiums that it pays for the insurance companies issued by the captive insurance companies. And then the captive will either convert those premiums into reserves that it keeps, or will use part of the money perhaps to reinsure the risk with another carrier, perhaps a commercial insurance company, perhaps another captive insurance companies. And so the tax code says that if you've got a small captive, referred to sometimes as micro captives or CICs, you can exclude limited amounts of the premiums paid that the captive receives, because the captive has to create reserves or has to share the premiums with reinsuring entities. And so the money that comes in is not all taxable, and in some cases the captive may pay income tax only on its investment income. The insurance premium that comes in is allocated completely to reserves and expenses, and so there's no net profit for the captive to pay. And so you get a deductible expense by the operating company without having to include that expense in taxable income when the captive receives it. So the captive insurance companies have come under attack in recent years. The IRS has said that many of the implementations lack the substance of real insurance relationships. Some of the difficulties or some of the arguments that the IRS has been successful with is that the coverage fails to match real business needs. The premium amounts are tied to how much the operating company wants to deduct, rather than any kind of actuarially justified risk that the operating company ought to be insuring against. And then the administration of the policies by the captive doesn't match up with actual claims experience of the operating company. They aren't treating it like a real transaction, in other words. Before we get into the attacks, let's talk about the role of life insurance here. Well, if you've got a micro captive that's collecting premiums from the operating company, and the micro captive needs to create reserves, well, micro captive might decide to invest in investable assets, or might decide to invest in permanent life insurance. Permanent life insurance, particularly a contract with low surrender charge or no surrender charge structure, would be a reasonable way, it is argued, for the captive to park its reserve money. That money inside a permanent life insurance policy grows tax deferred, and the captive itself won't pay income tax on any investment income if all of the money is invested in permanent life insurance because of that tax deferred nature. And the reason is that the reserves don't create an income tax result for the captive. They are monies that are set aside to pay for the risks that the operating company is insuring against. And so putting the package all together, deductible contributions by the operating company, captive doesn't have to include those monies in its taxable income, and then the money's parked in permanent life insurance. So it's a way indirectly to pay for life insurance on a pre-tax basis. So the IRS doesn't like that. The IRS, as those of us who have been paying attention over the past few years, has shot down virtually every idea where life insurance is paid for with pre-tax money. It's no different here. The life insurance aspect isn't necessarily attacked directly in the court decisions that we'll talk about, but the captive structure itself is what has been attacked. And we'll talk briefly about Salty Brine and Avrahami cases, and then we'll finish with the Syzygy case. Easy for me to say. So let's talk first of all about Salty Brine. We've got two Texas oilmen were sold on a captive insurance company by a promoter. They funnel most of their business's earnings into life insurance policies beginning in 2002. The IRS audits their 2006 return. The idea here was that they were self-insuring their risks indirectly using life insurance. 85% of the premiums paid to the captives by the operating company were shifted into life insurance policies. The other 15% went to administrative fees. 2006, the business paid more than $4.5 million in premiums, which were deducted as ordinary insurance expense. And then indirectly, the money was returned to the business owners through tax-free loans through their captive insurance companies. And the district court found, and the appeals court upheld, that this wasn't a real captive case, and that the deductions were disallowed. Now, that's a 2014 case. What's happened more recently? Well, in 2017, the Avrahami case, tax court case, was decided. The Avrahamis, a married couple, owned a jewelry business and a real estate holding company. The Avrahamis tried to make the money up to $1.2 million in premium be associated with a business risk for their operating companies. Their lawyer helped them swap the liability coverage with coverage from another micro-captive company. It was, I think, intended to look like a reinsurance arrangement. Basically, the policies were swapped for one another. The primary part of the coverage was indemnity against terrorist attacks. The premium amounts weren't calculated by an actuary, but they started with how much of a deduction the Avrahamis wanted to generate, and they worked backwards. So, it seems unlikely that a jewelry business would necessarily be exposed to a terrorist attack, and it seems unreasonable on its face that a $1.2 million premium would be payable to an insurance company for such coverage, a terrorist attack exposure on a jewelry business. And the IRS said, we're not sure what risk is really being covered here. So they sued to disallow. The tax court concluded that the Avrahami setup was not a valid insurance arrangements and disallowed the deductions on the premiums that were paid. And that brings us to the Syzygy case, relatively recent. The Syzygy case is another tax court case. The tax court started its analysis by observing that in order for insurance premiums paid to a captive to be deductible, it has to be a real legitimate insurance situation. The company here was Highland Tank, various affiliates owned by two families. In 2008, those two families formed Syzygy. And then in the following tax years, 2009, 2010, the Highland Tank companies paid Syzygy more than $500,000 in insurance premiums for certain risks. Some of the risks were administered by Syzygy, some were partly reinsured by third parties. And then Syzygy parked the reserves in split dollar life insurance plans with various members of the companies that owned the Highland Tank companies and the captive companies. And ultimately, the court decided that Syzygy wasn't engaged in the legitimate business of insurance. In support of its conclusion, here's what it said. It said the premiums for coverage in 2009 were not calculated by an actuary. There was no independent actuarial evaluation of the risks covered and whether the premiums were reasonable. Companies didn't actually issue insurance policies until after the coverage period ended. Highland Tank didn't actually file claims against its captive company, while it did file claims for other types of commercially insured losses. The terms of the insurance policies were more favorable to the captive than provisions that applied to carriers of commercial insurance companies. And then Syzygy changed one of the key relationships with its captives in 2011 because it thought that Highland Tank was paying premiums that were too low. They wanted to pay higher premiums and generate higher income tax deductions. And so in light of all those facts, the court disallowed the tax deductions for the amounts paid by the Highland Tank operating companies to Syzygy. This continues the string of cases where the captives' premiums for deductions for premiums were disallowed. A couple of last thoughts before we finish up. Captive insurance companies, the IRS has reported that those are transactions of interest. That means that the IRS is paying close attention to companies that implement captive insurance companies, micro-captive insurance companies, and putting close scrutiny on those. That ought to make any one of our clients who has a captive at least a little bit nervous. Anybody who's considering implementing a captive ought to think once, twice, perhaps three times about doing it in light of the high IRS scrutiny. The IRS recently published a press release that it was offering a settlement deal to certain taxpayers who had previously implemented captives. That was announced in the notice there on the slide. In order to be, it's a limited number of taxpayers who are eligible for this. First of all, the taxpayers have to be under review by the IRS for at least one of the years that involves their captive insurance companies. The taxpayers have to agree that at least 90% of the deductions previously taken, perhaps more, depending on the circumstances, would be disallowed, and the captives must be shut down immediately. The IRS apparently thinks of this as a generous offer. I'm not sure how many people would take advantage of it, particularly if nearly all the deductions are disallowed. On the other hand, if somebody under review who has a captive refuses to take part in the settlement offer, they run the risk of having their captive premiums completely disallowed, and also having their arrangement fall under the category of a listed transaction and expose themselves to those types of penalties. So maybe this is a generous thing. I'm not quite sure, but taken together, it's a signal from the IRS that it doesn't like micro captives and micro captives that are centered around life insurance are certainly not something that they favor. So what are the conclusions? Micro captives have an obvious advantage if they work as the promoters promise. Life insurance is paid for, permanent life insurance is paid for with pre-tax money. Unfortunately, it's not as easy to implement captives as promoters would have us believe. There's high costs, and the IRS scrutiny makes it, kind of an expensive road to go down. Is there a place for captive insurance companies? Yes, but the market's limited. And for most of our clients, it wouldn't be something that I would think that we'd recommend for them. And of course, are all operating companies and their owners candidates for captives paired with life insurance? Certainly not. The Syzygy decision, Salty Brine, Abrahami, the fact that captives are transactions of interest, and the fact that the IRS is going after captives with audits and offering not particularly attractive settlements, I think all reinforce that idea. So if we can help you answer questions about this or anything else, please let us know, and let me turn the program back over to Jennifer, who will close us out. Jennifer?
Thanks, Linus, and thanks for joining us today. And don't forget to join us next month for Roth conversions, yes or no. As a reminder, if you would like to receive supporting materials, feel welcome to email me at asktheexpert@advancedunderwriting.com. Again, that's asktheexpert@advancedunderwriting.com. You may also email questions related to today's webinar. Finally, for more information about the services that Advanced Underwriting Consultants offer, including phone consultations and newsletter licensing, and any of Linus's books, feel welcome to contact me at 615-224-1291. Again, that's 615-224-1291. Thanks again, and best wishes for continued success.